Oh boy, the bond market is exploding. Like we are seeing the global bond market is exploding. The yields are spiking to a level where we haven't seen since 2008. Like US 10-year treasuries is approaching 4.5%, right? Canadian 5-year bond yield is approaching 4.2%. Like we haven't seen these levels since global financial crisis in 2008. That's how significant it is. And the reason is basically the Federal Reserve decided to keep the rates at the current level yesterday. But we are now seeing the details being unfolded. The market is absorbing the minutes of the meetings by going through each and every single word of what they have talked about. And when we saw or heard Federal Reserve Chair Jerome Powell talking about it yesterday, he was keep repeating one thing: higher for longer, higher for longer. So that means when we look at the dot plot is basically a consensus between different Federal Reserve leaders about how they are going to predict the rate hikes or cuts over the next period of years. We're seeing that even until 2026, the rates are not going down below 2.5%. So this is just forecast prediction. What's going to happen in the reality, that could be a different topic because it's all depending upon the economic situation, recession, jobless, unemployment. But the jobless claims came out today, lower than expectation. So that means the labor market is still pretty tight. And when the market is absorbing these details, they're predicting that the monetary policy is still going to be much tighter by seeing the inflation spiking and the unemployment is quite low, which means the wage spiral, the wage pressure that we're talking about is still going to remain in the labor market. What is going to do with the mortgage rates? Because that's going to directly impact the housing market. In the US, it's already approaching 7%. And in Canada, we are already seeing 6.2, 6.3% on the fixed side, and this is going to go further higher, maybe 6.5 or 7%, who knows, because the 5-year bond yield in Canada is influencing the mortgage rates on the fixed mortgage side. So if the 5-year yield is approaching 4.5, maybe 4.8%, this is going to explode at the mortgage rates in Canada on the fixed mortgage side. So this is going to add a lot of pressure on the housing market, and we are already seeing a lot of trouble in the housing market, especially in the pre-construction sector, when a lot of people have booked their pre-construction units in 2020, 2021, even 2022, when the prices were that high. Now they're down 30%. They are not able to close it, or they're not willing to close it, so they are going to get breach of contract by not fulfilling their contractual obligations. So I was talking to a lawyer, and he was telling me how busy they are in terms of dealing these kind of cases. So a lot of pressure happening in the housing market, both in the US and in Canada as well. This is not a good sign, guys. So keep an eye on these things. I'm just giving you a very quick summary of what's happening in the market. The market is really in turmoil today. Like if you look at the stock market, even the bond market, it's all red. And don't forget the oil pricing. Oil is spiking up again, touching $90 a barrel. What's going to happen when it crosses $100 a barrel? Think about that, how this is going to increase the CPI back up again. We're already seeing 4%, right? Another continuous 2 CPI figures backing up again. And if the oil shoots up to $100, think about the CPI will likely to hit again 4.5 or 5%. Who knows? So a lot of uncertainty, guys. So again, another message for you: don't take any risky bets. Keep your savings pool accumulated, because things can go south very quickly. Like this video, give me a thumbs up, subscribe, and I'll see you in my next video.